6,959 crore. That's the dividend SBI paid to the government. You would have seen the big fat check given to the Finance Minister Nirmala Sitharaman. SBI declared a dividend of 13.7 per share for the financial year 23-24, much higher than the 11.3 per equity distributed previously. During 23-24, the bank earned a record consolidated net profit of 67,085 crore against 55,648 crores in the preceding year. Over and above this, India's banking sector net profit crossed 3 lakh crore for the first time. यार इस फिगर में zeros कितने होते हैं? To put things in perspective, 3 lakh crore is approximately the total quarterly profits of all listed companies in the first 3 quarters of the fiscal. In fact, banks' profits are much higher than those of IT services, which have been the most profitable group in recent years. Listed IT service companies reported a net profit of nearly 1.1 lakh crore for FY24. The net profit of listed public and private sector banks rose 39% to 3.1 lakh crore from only 2.2 lakh crore in FY23. But you will ask me, Akshay, why are we discussing this? What is the relevance of this? Well, let me answer your question. The most important achievement here is the revival of PSU banks. The public sector banks generated a record 1.4 lakh crore in net profit during the year, an increase of 34% over the year ago period. In the preceding years, public sector banks had narrowed their profit gap with private banks as they had cleaned up their balance sheets and increased earnings. The net profit of public sector banks has more than quadrupled in the last 3 years, just 3 years. But you will ask me again, why are we discussing PSU banks? PSU banks have always existed, right? Suddenly, why are they becoming the talk of the town? Well, PSU banks have been the backbone of the Indian economy, accounting for as much as 2/3 of the overall banking volumes in our country. That's the scale at which PSU banks operate currently. Although we have private sector banks in Tier 1 and metro cities, the majority of the banking needs, especially of the rural and semi-rural areas of India, are segmented through PSU banks. Above and beyond this, a large part of capital expenditure incurred by the government is sanctioned through PSU banks as well. But wait. That is a lot of data to begin with. First, let us understand the importance of PSU banks through a 5-step framework. 1. PSU banks have a significant share in the total banking asset. As of March 2023, PSU banks held approximately 58% of the total banking assets in India. PSU banks collectively manage assets worth over 100 lakh crore, playing a crucial role in the country's banking sector. 2. They are a major source of credit to priority sectors. PSU banks account for over 70% of the total credit dispersed to priority sectors such as agriculture, small and medium enterprises, SMEs, and education. In the financial year 2020-2021, PSU banks dispersed more than 10 lakh crore in loans to the agriculture sector alone, supporting millions and millions of farmers. Third, their role in financial inclusion. PSU banks are instrumental in implementing government schemes aimed at financial inclusion, such as the Pradhan Mantri Jan Dhan Yojana. As of March 2024, approximately 519.5 million PMJDY accounts have been opened, with the public sector banks contributing to over 90% of these accounts, ensuring extensive banking access, especially for the unbanked population. Fourth, they provide a strong support to government initiatives. PSU banks play a pivotal role in the disbursement of subsidies and direct benefit transfers under various government schemes. If we talk about the fiscal year 2020-2021, PSU banks facilitated DBT transactions worth over 2.5 lakh crore, directly benefiting millions of citizens across the country. 5. They are a key player in infrastructure financing. PSU banks are major lenders to infrastructure projects, contributing to more than 60% of the total financing in sectors like power, roads, telecommunications. In 2020, PSU banks had an outstanding loan book of over 15 lakh crore dedicated to infrastructure projects, supporting the nation's economic growth and development. Well, I think it is clear now that PSU banks have a major role in the Indian economy. But what has been the pertinent issue with the banks over the years? Why have they slightly underperformed? So there have been 4 major problems that have been plaguing the Indian public banking system. First, as we all know, is about the growing NPA crisis. PSU gross NPA percentage rose to an alarming 14.6% in 2018. Banks give out loans and earn revenue through the interest generated on the loans. When the loan is not paid, it becomes a non-performing asset for the bank. To put things in perspective, when the Atal Bihari Vajpayee-led NDA government took office, the gross non-performing asset ratio or the GNPA ratio in public sector banks was 16%. And when they left office, it was a mere 7.8%. During their term, they had almost halved the ratio. That was a substantial change brought in, but then the UPA government came into power and unfortunately problems started creeping in. In September 2013, this ratio, including restructured loans, had climbed to 12.3% during the tenure of the UPA government. Let's move on to the second point, which is PSU banks tend to have poor governance and management. Well, frequent political interference in the functioning of PSU banks undermine their operational independence. Inefficiencies and lack of accountability among the management resulted in poor decision making. Third, PSU banks have high loan waivers and populist schemes. Frequent loan waivers, especially in the agricultural sector, eroded the credit discipline among borrowers. Populist schemes announced without proper financial backing strained the resources of the PSU banks. Fourth, lack of capital adequacy. PSU banks struggled with insufficient capital, limiting their ability to lend and support economic growth. Recapitalization needs were not adequately addressed, leaving banks undercapitalized. Adding to this was the infamous IL&FS crisis. The IL&FS default in 2018 triggered a significant financial crisis in India, undermining the confidence in the entire financial system. IL&FS, a major infrastructure financing firm, defaulted on 91,000 crore, roughly equal to $13 billion in debt, leading to fears of systemic instability. This default increased risk aversion among market participants, raised borrowing costs, especially for entities with asset liability mismatches, and led to heightened provisions and write-offs for lenders. So then the question is, how did the turnaround happen? What changed the fate of the entire public sector banking system? And to solve this, the government and RBI in 2019 came up with a 4R framework to solve the PSU banking crisis. It included measures around recognition, resolution, recapitalization, and reform. Let's start with recognition first. In 2016, the RBI conducted an asset quality review or AQR that identified 3.5% of the banking system's loans amounting to approximately INR 2.5 trillion as stressed. This led to transparent recognition of these loans, reclassifying restructured advances as NPAs and provisioning for expected losses. This transparent recognition increased gross NPAs for PSU banks from a mere 5% in March 2015 to 14.6% in March 2018, implying significant financial write-offs of over INR 10.19 lakh crore. Consequently, banks had to increase their provision for bad loans, which severely impacted their profitability and resulted in several banks being placed under the Prompt Corrective Action or the PCA framework, restricting their operations and growth. By addressing hidden NPAs, the AQR laid the foundation for financial stability and future growth. 2. Resolution. Restructuring loans involved more time, feasible interest rates, and restructuring covenants to increase repayment likelihood. Recovery efforts empowered banks to take swift legal actions, proceed with collateral sales, enforce bankruptcy, and incentivize defaulters to repay, leveraging the Insolvency and Bankruptcy Code or the IBC. The IBC's efficient debt recovery process achieved an average recovery rate of over 40%, not only reducing resolution time to 460 days in 2021, but also improving India's ease of doing business rankings. Third, recapitalization. To revitalize the banking system, the government infused an unprecedented rupees 3.1 lakh crore from 2016-17 to 2020-2021. This capital injection helped write off 22.3% of NPA loans, cleaned the balance sheets, and prevented potential defaults. Mergers reduced 20 PSU banks to only 12, creating stronger entities that met capital adequacy requirements and managed net NPAs much more effectively. Fourth, reform. The bank's board bureau, established in 2016, enhanced governance by overseeing PSU banks' performance, leadership appointments, diversity, risk management, and of course, whistleblower protection. The creation of the National Asset Reconstruction Company Limited or the NARCL in 2021 with a government guarantee of INR 30,600 crore further helped clear toxic assets from the bank's books, boosting profitability and recovery revenues.
Up to 30,600 crores for the security receipts which will be issued by the National Asset Reconstruction Company Limited.
Now that we know the importance of PSU banks, the problems they faced over the years, and the solutions that were deployed to revive them. Let's understand what was the impact of these measures. Impressive financial turnaround. Since 2019, PSU banks have turned around financially, growing net revenue by 17.8% annually, beating private banks 14.9%. Their net profits have also grown 17 to 18% annually since 2020. By 2024, all PSU banks are expected to be profitable, unlike 2018, where only 2 out of the 21 were profitable. Second, reduction in NPAs. A key part of the turnaround has been reducing gross non-performing assets or gross NPAs from 14.6% in March 2018 to only 3.7% by Q3 FY24. Net NPAs also fell from 5.9% in 2017 to only 0.85%, showing improved asset quality and aligning closely with private banks. Third, strengthening balance sheets and capital adequacy. PSU banks have strengthened their balance sheets with rupees 3.1 lakh crore infusion from the government between 2016 to 2021. Improved governance and capital adequacy ratios well above the required levels have boosted their ability to handle losses. Consequently, they've exited the PCA framework, ensuring stable and sustainable operations. This becomes a very important case study for the revival of PSUs in India due to the structural reforms, especially in the last decade. Well, this is Akshay. See you in the next one with another breakdown.